There was once a single company that bound together the world's major banks, an insurance giant called the American International Group, or AIG. To keep their balance sheets looking healthy, banks packaged high-risk loans into complex bonds and traded them among themselves at steep discounts. Betting on luck, or on being too big to fail, AIG insured these lethal bonds recklessly. The exposure ballooned to over $500 billion in insurance guarantees, gripping the fortunes of many of the world's major banks. In 2008, when those toxic bonds defaulted together, the major banks were pushed to the brink of a systemic collapse. Only AIG's insurance payouts could save them. But AIG could never cover the more than $500 billion in guarantees it had written. So the U.S. government injected $180 billion, not to save AIG, but to save the global banking system. It wasn't new. 2 centuries earlier, Britain had already faced the same danger. In 1772, the East India Company had effectively defaulted. London's bill market froze. The British Treasury injected £1.4 million, equivalent to well over £10 billion today. It was the first large-scale corporate bailout. It was the same algorithm, only with bigger numbers after 236 years. Because risk never disappears, it only changes its name. We returned to the table where imperial credit was born, a 3-way deal among a crown, a parliament, and a class of merchants, each trapped by their own crisis. The crown wanted empire but could no longer afford it. Wars, fleets, and colonies devoured silver. Parliament wanted revenue but feared revolt. A century of Tudor rebellions and failed tax experiments had taught them that new taxes were political suicide. They needed an invisible tax, wealth arriving from beyond the horizon. London's capitalists wanted safety without stagnation. They had money but nowhere to send it. Government bonds paid too little. Private ventures were too risky. They dreamed of a machine that could turn danger into design, risk into yield. A circle of London merchants proposed a simple bargain. Let private capital finance empire, while the crown merely shares the dividends. In 1600, Elizabeth I signed the Royal Charter, and the East India Company was created. It could fight wars, govern territory, and collect taxes in the crown's name. But the cost was paid by its private investors, not by the English Treasury. The company was built as a finely engineered device that converted risk into profit, using its own balance sheet as the engine that allowed the empire to expand. During the company's rise in the 1600s and early 1700s, its system worked with remarkable internal consistency because every major actor received money simply by keeping it running. The crown received annual payments and dividends from the company. This financial flow became a quiet but dependable source of income for the monarchy, rarely questioned by Parliament. Parliament, in turn, collected customs duties and taxes generated by the East India Company's trade. And the East India Company collected revenue overseas, funded the military presence abroad, and sustained British rule in regions the government could not afford to administer directly. Above all of them sat the shareholders. They earned returns by circulating capital through the system. A dividend was only the beginning. Company shares could be pledged as collateral for loans. Those loans could be used to buy more shares or government bonds. Company shares, government bonds, and private loans all circulated among the same hands. Investors became creditors. Creditors became investors. Corporate profits upheld public credit, and public credit inflated the company's valuation. Eventually, the loop closed completely. The company purchased government bonds. The Treasury used the same money to buy the company's debt. At that point, the two institutions merged into a single financial organism. If the company collapsed, the state was endangered. If the state struggled, the company's valuation would fall. Then the system expanded again. The company issued its own financial instruments, long-term bonds and short-term bills, which merchants used to pay wages, settle debts, and move goods. Banks, merchants, and ordinary Britons treated the company's notes as if they were cash, because they could be exchanged for pounds at any time, and no one seriously believed the company would ever default. It was not creating gold, it was creating confidence. As the company's paper spread, ordinary Britons became part of the financial loop. Pension funds, church trusts, and private savings all held company debt. Households that never fought in the empire's wars and never voted on its taxes now depended on the company's credit for their daily security. With each step, profit, credit, and risk became more tightly connected. Newspapers began calling it the engine of empire, a system whose center of gravity had shifted away from the monarchy and into the ledgers that linked state finance with corporate power. But a system that depends on constant motion cannot pause. Once the flow slows, the structure begins to suffocate, and in 1772, it finally did. Bengal, the company's richest province, was hit by drought and famine. Land tax revenue collapsed, and those taxes were the money London depended on every year. Yet British banks kept discounting the company's bills, turning its short-term notes into cash as if yesterday's profits still guaranteed tomorrow's stability. Soon credit, not revenue, was the only fuel the system had left. When Bengal's remittances stopped, the company suddenly had no cash to meet its obligations. Its discounted bills stopped coming back, leaving banks with loans they could no longer recover. Runs spread across London. Banks' silver reserves drained rapidly, leaving them unable to support the vast credit bubble tied to the company. When the company stopped paying its bills, government revenues fell sharply, deficits widened, and the Treasury was left struggling to meet interest payments on public debt. Shared profits now meant shared losses. Banks failed, merchants failed. Ordinary Britons then discovered that the company notes they held could no longer be redeemed for silver. Crowds filled the streets demanding answers. A hard truth emerged: an economy built on mutual gain must also share its pain. The empire's balance sheet cracked, and the faith behind it cracked too. Rescue was not about spending money, but restarting circulation. The Treasury issued fresh bonds backed by future taxes. London's wealthy families and insurers used the silver they still held to buy these new Treasury bonds, the safest asset left in the crisis. The silver flowed into the Treasury, then back out as loans to the company and to the banks. The company used its share to clear overdue obligations, pay suppliers, and buy back some of the notes it had issued. With cash again in hand, confidence returned. Its short-term bills finally traded again. Markets began to breathe. The banks used the rescue silver to issue new loans and resume discounting the company's short-term bills. The people who received those loans still needed a place to keep the money, so they deposited it back into the banks. Those deposits could then be lent out to others. The silver itself hardly moved, but the credit built on top of it kept expanding through the ledgers. As credit creation resumed, the company regained short-term financing from banks and secured enough cash to survive the Bengal crisis. Share prices steadied, household wealth recovered, and investors returned. The financial cycle restarted. But this stability came not from company revenue, but from a credit structure built on government borrowing and public confidence. Private risk had been transferred onto the national balance sheet, but the rescue had an unintended consequence. Parliament passed the Tea Act to help the company repay its loans, letting it dump its unsold tea in America at artificially cheap prices, undercutting local merchants, while still collecting a small tax on every sale. The tea was cheaper, yes, but it came from a forced monopoly, a price designed to crush local trade and assert Parliament's power to tax the colonies at will. A discount that hid domination, and it ignited a revolution. Britain saved a company, only to lose an empire. The rescue worked, but it changed the system. Private losses were absorbed into public credit, and government became the final backstop for finance. From that point on, any institution large enough to endanger the system could not be allowed to fail. Thanks for watching. This is the floating ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.